So this is a panel about strategy, what is the right strategy, and maybe whatever the right strategy is now won't be the right strategy in the future. But being a Wall Street guy, we always look at the stock market to tell us how the investment community is looking at things. And my little thing here is not working. All right. Can you tell me what to do here? There we go. Okay, I'll get to that in a second. If you add up the value of all the casino companies, all the publicly traded casino companies, it works up to about $250 billion, $250 billion. And if you add up all of the gaming technology companies, whether it be the slot manufacturers to the iGaming operators, it adds up to about $125 billion. So you're looking at $375 billion and two different strategies in the casino industry. Do we operate technology, iGaming and the like, in-house? Or do we make a deal with an expert in the space and let them run it and try and share in the profits? What we have over here on this slide, which is very hard for me to read, but let's just make the important observations. The yellow dotted line where it looks at the last 2 years, you'll see that the NASDAQ is about flat. That's the indication of the technology world. The green line above it, which is close to about 10% up on here over 2 years, is the S&P, which is the 500 largest companies in America. At the top, in the blue, you have the regional operators that have focused on land-based casino only, like Boyd and Churchill Downs and Monarch and Red Rock, who have really not focused a lot on bringing the technology in-house. And the red line on the bottom are the tech-focused casino operators, which were all the rage a year ago or 2 years ago. Caesars, Penn, and Bally, who have spent a fortune to bring the technology in-house. And they have clearly underperformed the market. So with that, we've got the head of Interactive from Caesars here. We have Tim Drehkoff, who's the CEO of Rush Street Gaming, which is a land-based operator that spun off its technology business. And we have Marcel Tobler from Stadtcasino Baden, who has experienced it all, being in Europe and being one of the forerunners in the online gaming business. I'd like to start this with the big guy, Eric, here on the table, on the dais. Tell us about, Caesars has been the technology leader, is probably the biggest company in the industry, and the technology leader by far forever. I mean, going back to the 90s, I guess, and early 2000s with Total Rewards, they were at the forefront, and you bought William Hill. You've made all the big moves, if you will. Tell us about your strategy and why you're sticking to it.
Yeah, sure. And thanks for having us here today. We firmly believe that over the long term, the best outcome is going to be one where your online product is integrated with your retail product. And we think that there's going to be a sizable portion of the customers that are going to value the ability to play online wherever they are, and then to redeem their rewards or get benefits at a retail location in Las Vegas or in Atlantic City or what have you. And our view is that will allow us to allocate costs across both channels more efficiently, ultimately have lower cost of acquisition, higher retention, and eventually translate into a better profitable business. And so, yeah, we made a big move to acquire William Hill because we, along with Eldorado, were effectively behind at that point. We needed to buy a technology provider. Luckily, William Hill had embarked for a couple of years before building their own platform. And so it was the perfect opportunity to bring that in-house. We've since staffed up the team. We have made a sizable investment in the tech side, and our plan is to continue to own our own technology and make sure that it's seamlessly integrated into our rewards program and all the different aspects of the technology that are experienced at the property level.
And why isn't the market recognizing it?
We ask that ourselves a lot. We have a business that's growing, around 100% year over year. It's an incredibly scalable business. We're negative $5 million in EBITDA in the fourth quarter. So we've shown that this is a very good business. I'm excited about the prospects. I think it's a very good business over the long term, and I just think we're in a spot where companies are not getting rewarded for future cash flows, partially because of what's going on with the interest rate dynamic, just the industry space. To your point, you saw that the declines over the last 2 years have put kind of a sour on the casino and the online space. Eventually that'll change, and I think we'll be rewarded handsomely when that does.
Long-term play. Tim, Rush Street had gotten into it right away, built a very compelling business, but spun it off, as did our client Tillman Fertitta at Golden Nugget, one of the best iGaming operators, spun it off into a company that's now part of DraftKings. Churchill Downs got into it and got out of it. Tell us the flip side of the story. What's your logic in that?
Yeah, well, thanks for having me here. And I'll characterize it a little bit differently. We didn't spin it off. It was just started being off. And it was actually 10 years ago this month that Richard Schwartz joined our organization, and now he's the CEO of RSI, but that's when we really started Rush Street Interactive. We were a real estate company, a traditional real estate company, before we were even a gaming company. The gaming company came out of the Bloom family office, and Bloom had a very successful real estate career for decades before we even got into gaming. That DNA exists in our casino company. Each of our casinos is actually a siloed capital structure where we don't commingle funds. So when we started, and they all cash flow very nicely, and we love being in the casino business. When we embarked on the online business literally a decade ago, it was very uncertain. We didn't know where it was going to go. We did know that it was going to require substantial investment and not have any cash flow for an undetermined period of time, but years. So we made the decision back then, don't commingle the capital structures of the very successful and valuable cash flowing casino businesses with this unknown new risky venture. So we started it out from the very beginning as a separate animal. Fast forward to today, we do recognize the obvious benefits of having synergy between the online and the bricks and mortar. Like Eric mentioned, we, for better or worse, we try to achieve that through commercial agreements between us, casino company, and Rush Street Interactive. We obviously share the brand, Rivers, Bet Rivers, and in the markets where we operate online and bricks and mortar, we share the customers too.
So how do you look at the stock market chart that I showed before, that you and your peers, and you're not public, but your public company peers in the real estate business are soaring, and the technology-heavy companies that are focused on the integration are not performing? Is just this flash in the pan, or is just bad market sentiment? As I mentioned before, these are big numbers, right? We're talking about billions of dollars of value that the investment community is saying that, hey, we don't like it together, or at least enough people are saying they don't like it together. Well,
my first reaction from looking at the stock market charts is, very happy that we're a private company, not a public company, so ours isn't up there. The way we think about, we're a family-owned business. We're not a private equity business. We're not a public company. We have the luxury at Rush Street Gaming and Rivers to think about the ultra long term for our business. So the ups and downs of the stock market for us really don't mean anything. We think about long-term cash flow and value generation for the family and generations of the family that own our business.
So it's interesting because what it sounds like is what I heard from Golden Nugget is that, I'm in the real estate business. I'm focused on the real estate business and delivering that product. This is a different thing, and I'll deal with it through commercial relationships. Marcel, you are, the ideal person here to balance this all out, because you're a public company. You were primarily a land-based operator. You embraced technology quickly. You brought it in-house, and you even became a B2B operator because your technology was so forward. how do you see it all, and what lessons can we learn? Is it the long-term play that's going to be the right way to do it, or what is the market telling us?
Yeah,
what is the
so-
market telling you at home?
I think there is not a right or a wrong thing, but I think important is that there is a strategy behind it and that you have a plan. What is your edge? What's your competitive advantage in the market? And one competitive advantage could be having control over the technology and over your online operation. However, it will be more complex at the beginning, and maybe that's also what your experience is. It's difficult to explain why others that work together with third parties, that depend on third parties, may actually capture more market share, maybe be more profitable at the beginning, but I seriously believe in the long term, having control over technology, having control over your interactive business gives you a broader opportunities, and you have more possibilities on a strategic level. And that's complex to explain to investors or to traders. We had some interesting panels yesterday where one point was, as a public company, you have to focus quarter by quarter. And the strategy to invest into technology is, as you mentioned, a long-term strategy. And I believe if you have, let's say, the strengths to endure that hard beginning, you will profit in the long term.
So that's very interesting. So there's really two strategies of bringing customers into iGaming, right? One is what I always heard about, the sports betting being the on-ramp for iGaming. We're going to get sports getting dominance. We're going to have all these customers, and then as we get iGaming market to market, we'll have the ability to bring them in and make money off them that way. The other strategy, of course, is I have a land-based casino. I'm going to use that as my incentive to the iGaming customers because I can reward them when they come to the property. Tell us a little bit about how that's working. I understand well, I think most people understand how the sports betting and iGaming work together, but how is it going in terms of integrating iGaming and sports betting with the land-based casinos?
Yeah, it's a great point. It's something that we've been really focused on, and we've made a lot of strides in terms of the integration between the two. There is a clear subset of people that do like to play online and then redeem their rewards at the property, or vice versa, earn at the property and then redeem online. And we've been able to facilitate that translation between the two entities. What we've lacked is a bit of the seamlessness that you'd expect on the tech side. So it's still not a perfect experience for the customer. For example, if customers are playing online, they can redeem and get discounted rooms at Caesar's Palace today on their app. That should be a big product because we know people like to go there and it's aspirational and so forth. It's just kind of clunky and it's not as smooth as it should be. And so we really haven't pushed that much. So customers do use it, but it hasn't been a real focal point. Over time, as we get our databases merged, as we get the front end of the application built, as we get a shared wallet between all the different states and between Nevada, then you'll start to see us edge into a point where we can push those products and highlight them on the app, highlight them through our marketing materials. And I think that's when you'll really start to see those synergies. The reality is we're signing up many times more customers online than we ever had from the retail perspective. So the potential's huge. And we're clearly committed to doing that. It's just been slowed down by some of the tech deficit that we've been facing.
And we've always heard that iGaming customers, there's no cannibalization, right? We were talking about that on a prior panel. They're a different customer. Are they a different customer? I mean, you've now seen so much of it. Do they start off as different customers and they become the same? Do you have any metrics at all you can share with us in terms of overlap or?
Yeah, it's probably a little too early to say. The best example is probably New Jersey, where they've been around for, it's had the product the longest. And we came to the same conclusion that there's not cannibalization between the two. There are certainly customers that just like to play online. There are certainly customers that just want to play retail. But there are customers that want to do both. And we are seeing that. And you're seeing customers that were probably splitting their wallet with other companies. And when they realize that they can consolidate their spend and then get incremental rewards, that's something that is pretty compelling for both them and us.
But no metrics that the company is willing to talk about yet.
Yeah, we haven't provided any. And it's still early days. A couple companies have launched wide area progressives that are both online and retail. I think that's a big, really interesting thing for the consumer. We also have a trial going on where a customer, if they're playing at a slot machine in Atlantic City, can scan a QR code and it'll take them to the same game on their app, which is really interesting. Yeah. And so it's early stages here in terms of the merging of the technologies, but there's a lot of really interesting things that I think that are going to appeal to the customer that will cause this to be advanced in the future.
So Tim, you're less constrained because you're a private company, at least the Rush Street, but you're still very connected to Rush Street Interactive. You share a name, a lot of shared ownership. What have you been experiencing in terms of overlap? My understanding is that one of the reasons you're so successful relative to others in the iGaming business is because you've been able to leverage your casino involvement in certain states.
Well, yes, we do share the customer base. That's part of the commercial agreement, and we have seen that there are customers who prefer to do both. But maybe without getting into our weeds, one thing that shows you there is overlap is if you look at just public data, bricks and mortar revenue in Pennsylvania, bricks and mortar revenue in Michigan, bricks and mortar revenue in West Virginia, and you compare it now versus 2019, relative to other states that don't have iGaming now versus 2019, there is a big difference, which illustrates that there is some migration from customers going from the bricks and mortar to the online. And that's one of the reasons why, as a bricks and mortar company, we're very focused on having the right commercial arrangements, the right strategy online, because we don't want to be Blockbuster Video 10 years from now. That's for sure.
Do you think that's possible? I mean, is iGaming has the potential in 10 years to replace online in-person gaming, or is
no,
it
I don't think it. I think it's two very different experiences. But there could be migration.
Marcel, tell me from your experience, what's the overlap? Have you seen metrics that you can share with us about what percentage of your customers does one or the other or both?
Yeah, so we have an overlap a little bit less than 50%.
50%?
Yes.
Almost 50%?
Yes.
It's big.
But actually the better news is 50% are not playing in the other channel. And that's a huge opportunity. And I agree with you, Eric, and a lot needs to happen in terms of technology to fully be able to utilize those opportunities. But what we have done, we have run some test cases. We invited VIPs from the online casino, which have never been in a land-based casino before, ever. We invited them to the casino. We had our VIP managers having dinner with them, drinking a beer, going through the casino, and it was great. 90% of those people returned back to the property by themselves later on through the next 6 months. So that's additional revenue for the land-based casino. But even better, for the online casino, in average, those people that were invited, they tripled their lifetime. And that has an amazing impact on the profitability if you are able to triple the lifetime. And to do that in a large scale, you need technology. The industry needs to do a lot in terms of technology to get there. But if you're able to control the technology, if you have a saying on the technology, you're able to move and to move forward. And I think that's important. And of course, you can have commercial terms. However, what I always feel is difficult, I don't say it's impossible, but it's difficult to have in the long term the same objectives. That you're in the long term the same incentivized, and not that one party is against inviting online player to the land-based property and vice versa.
It sounds like the institutional investor community that I showed up over there needs to talk to you, and the stocks would be worth probably a lot more. Let me ask you this question. Talk about scale. Scale is so important. You start with Caesars again. Caesars was built, the current Caesars was built from Harrah's and El Dorado, and building a lot of companies that consolidated the gambling industry. The land-based gambling industry is an illustration of consolidation. But all of these properties started off as separate companies. Scale when we talk about sports betting now, and we look about who the big players are, and then there's an awful lot of small players. Our advice to people as investment bankers, our advice to people is you've got to consolidate for the scale. How do you look at that as you look at in your position? Do you see yourself possibly acquiring other sports betting, iGaming companies in the future to gain that scale, or is it not worth it? You'll just beat them out of business by offering a better product and total rewards.
Yeah, from my perspective, and it's my view on this has changed as I've experienced the business that we're in for and trying to grow in all these different states. But scale is very important, and it's extremely important on the tech side. We have a lot of engineers programming for us to be able to get our product to the state that it needs to be in, so that the customers get what they want and experience what they need on our product, and we're able to distribute that over all the states in which we operate. And true, each state has technically a different version of the app, and each one is slightly different than the other, but there's a lot that's shared between it. And so that scale is really hard to replicate. And it's very expensive to build a product like this. We have hundreds of engineers programming every day to try to get all of the advancements that we need. And so it is going to be very difficult for somebody who doesn't have a lot of financial backing to come in, or somebody who's just operating in a few states, because they won't be able to distribute those costs. Then I think if you take it to the next level and say, where's the industry going in the future? Again, I just think scale is going to be very important, because you're going to want to offer your customers the broadest portfolio of amenities and products that they can choose from to participate in, and that's going to rely on having scale.
Does that scale, though, come from acquiring other B2C operators, or is it just and we don't really need that because no one's really that loyal. They're loyal. The only thing that differentiates is a higher quality product. So it doesn't pay to buy another B2C operator. It pays maybe to buy other technologies. Or did Penn prove that incorrect by buying the score? I mean, there's so much that's happened already, and then trying to read into that is difficult. How do you see it?
It is. We'll see how the score deal works out. From our perspective, we have 55 casinos, the most in the United States. We're operating in the most jurisdictions right now online, because we have access from all of the skins that we own from the retail locations. And so we don't see a need to go out and acquire anything at this point. We're growing, like I mentioned, around 100%, which is fabulous. We've accomplished the scale that we need, and so there's just not really a need, from our view, to go and acquire anything at this point.
Stay the course.
Yeah, and invest in the product.
Tim, you don't represent RSI, but you know it well. I mean, is that just your perspective now? Do you see that consolidation is a way is going to happen, or just the smaller guys are just going to get beaten out of business?
Well, from the RSG perspective, from the bricks and mortar perspective, we'd love to have more scale to be able to operate in more states, more jurisdictions, and have more avenues for bricks and mortar and online. We're very disciplined. We love to have it, but we don't want to overpay for it. We've developed every casino that we operate. We've developed 7 casinos. Never acquired one. We've been spoiled. One of them just opened, but the other 6 have been tremendous successes. So we're spoiled by those returns, and very disciplined with that capital. So there's kind of some friction there for us getting to the bigger scale. As far as our RSI is concerned, they're plugging away, doing what they've promised ever since ever since we started them, and they became a public company, and they'll keep doing that.
You know, I could keep going for another hour, but I'm out of time, and there's no one to give me the hook. Sarah hasn't been doing it. She's too nice. But thank you all for, let's give a round of applause to our panel.
Thank you.